Hi and welcome. I'm Steve Johnson, Chief Investment Officer here at Forager Funds, and I'm joined for our last video of 2023 by Harvey Migotti, Portfolio Manager on our International Fund. How are you, Harvey?
Very good, thanks. Yeah,
that's good. Look, this rally over the past couple of months has taken equity markets back. It's still been a pretty horrible year overall, but taken them back to levels sort of in line with pre-COVID and multiples back to levels that you wouldn't describe as screamingly cheap. But it's been very, very different by type of stock.
Yeah, no, 100%. I mean, there's at the moment in the market a very strong desire to own quality, things that are resilient. They don't outgrow significantly in good years, but they do, pretty well in bad years. We've actually seen a lot of research reports, coming out with their equity positioning predictions for 23 from a lot of the big broker houses, and everyone's obviously recommending a quality tilt. But if you actually look at it, and we've got an interesting chart to show you, the multiple premium that these quality companies have at the moment versus the broader market is at a 10-year high. So it's certainly getting priced in, and some of these stocks are trading at all-time high valuations still. Obviously for good reason. They are resilient and they deserve to be rewarded as such, but people are hiding there.
Yeah, and we've had a couple of stocks in the portfolio that are in that bucket that have done quite well for us over the course of the last year. And what would you include there? Keysight?
Yeah, Keysight. We own CDW for the first portion of the year, sold at higher levels than today. And names like Sony have proven their resilience through the year and been kind of rewarded when that does happen. So we've got some in the portfolio.
Yep.
So that's whacked in other parts.
That's helped a bit, but for those of us who like going against the crowd, there are sectors out there, and particularly sectors in small cap land that have been punished really hard. So where are the opportunities for people that are looking into some of these more distressed spaces in 2023?
Sure. Well, I mean, obviously, a lot of the sectors that performed really well in 2020 and 21 have seen a big unwind, whether that's because of COVID or just because they ran ahead of themselves. Obviously, interest rates are pressuring valuations. So they've had a bit of a pullback, And the trick here for 23, we think, is to find businesses that have been put in that bucket of, things are going to get worse for them, but actually won't. So maybe think stocks that are exposed to housing, but actually are more resilient than something that's directly a home builder. These names that can perform well through next year are ones that actually you can make a lot of money on probably as they prove their resilience through a tough environment.
Yep.
Which should continue over the next few quarters.
And another area has been stocks that were very, very hot in 2021, or sectors that were hot in 2021 that have been pummeled in 2022. Our largest investment, Flutters, in the sports betting sector, that was a huge favorite of people in 2021. It's been hammered in 2022, and yet we own a stock in that space. So is that an example of what you're talking about?
Yeah, I mean, that's actually a great example, every time, so DraftKings is a digital player in the US. Flutter owns FanDuel, which is a big part of the growth story here for their business. And what you see is, Flutter's been kind of beating most quarters over the past few quarters and doing really well. But every time DraftKings comes out with a profit warning, Flutter gets hammered. So investors are just putting things in buckets and moving stocks up and down, irrespective of the subtle differences that can occur within them. And that's where we're finding some good opportunities.
Yeah, sort of a baby out with the bathwater bucket, that there's some really good businesses in some of these sectors that,
totally correct.
That are unfairly being thrown in with the rest.
Yeah, that's 100% correct.
Let's maybe talk about some of this COVID unwind. We've been talking about it a lot with the Aussie fund team here in Australia. You've got businesses like JB Hi-Fi and Nick Scali that have sold off as people start worrying about how much profit they were making and what the sales were looking like during COVID. Are there opportunities in that space for businesses to buck the trend as well?
Yeah, we definitely think so. If you look at, for example, a name that we added recently, Yeti, it's what you would call a lifestyle brand. Maybe things like Lululemon are considered a lifestyle brand, where it's not just about the quality of the products, but also about the logo and whatnot else. They manufacture drinkware products and coolers, so high-end premium coolers. We're talking $300 to $500 to $800 products that are just much better designed and better performing than the competition. Drinkware products that keep your drink either hot or cold for a long period of time. This is a company that grew over 25% year on year for multiple years, for the better part of over a decade. The company's almost 20 years old now, founded in the US. But we think that for names such as this, there's some really strong secular parts of the story that can offset the cyclical headwinds that they'll be facing. I mean, in this instance, we can talk about the huge international expansion potential that's ahead of this company, which is growing really rapidly, even as recently as the September quarter that was just reported. They grew 60% internationally, adding a decent amount to the overall company's growth, even from a low base. So there are definitely pockets where you can find some exciting opportunities like this in a market that's just taking everything down at once because it has consumer discretionary exposure or U.S. housing exposure or whatever that may be.
Yeah, we go into a bit of depth about that stock on our latest podcast. So if you want to know more about Yeti, and get out there and try its products first leading up to Christmas, because that would be good for the portfolio, but also check out our latest podcast. Look, I think the space that's, I guess, got the most heated debate and the biggest amount of uncertainty still, largely because the impacts haven't yet hit, is the impact of this rising interest rate environment, particularly on housing, construction. You've still got businesses that are currently performing really well, but everyone can see the headwinds coming, and there's a lot of debate. Is there anything there that you're already comfortable investing in?
Yeah, well, I mean, we've obviously, we talked about this recently, but we actually added to the weakness we saw in Tektronic. It's a stock that we owned in 2020 and did very well out of, and it's been hammered. But if you look at the underlying fundamentals, this is a company that's now trading at an 10-year low earnings multiple. The earnings may be wrong for next year. There may be some further downside. Obviously, there's a lot of pressure on U.S. consumers, but it continues to take tremendous market share. And this is a business that invests a lot in R&D relative to their competitors. And even if you have a bit more pressure on the downside to next year's numbers, it comes out of this recession much stronger than it came in, we think. So businesses like that, great opportunity to be adding to the portfolio on a multi-year view.
And then some of these smaller companies that have just been hit by interest rates alone, where the business seems to be fine, but people are now applying higher discount rates and have really smashed up the multiple. We own a few little companies in that bucket. I mean, are they performing as you would have hoped? And what stops, I guess, that downward pressure on the share price?
Yeah. Well, I mean, we just to name a few, eGain, Janus International, which is exposed to the storage space, or storage and the consumer storage of products, that they don't want to have at home, which is actually booming and at all-time high utilizations in the U.S. Other names like InMode, they've been beating and raising through the year, and the multiples just compressed massively alongside, other things. They're all showing, good resilience, and they're coming into next year, even though it might be a tough year, at near rock bottom valuations relative to their history. So those are exciting places to be, deploying capital, obviously.
Yeah, we did that whole podcast actually around this small cap sector, and it's been hit so hard. There's actually some historical evidence for some of these stocks actually working really early in a recession, simply by proving up the resilience. People start to stop applying the discount that's being applied to it. So we're expecting some of that, not just hoping, but expecting some of that throughout 2023. Thank you for joining us and watching our videos this year. We hope you have a safe and wonderful break. Enjoy it, and we'll be back in 2023. Harvey, thanks for your time and all your hard work over the past year. Have a great break too, and we'll be back on the tools in January.
See ya.